All right, guys, we got to blow the whistle here, open up a page from Payne's investment playbook. Don't look now, but crude oil continues to surge, and there's a chance that a war with bullets will derail, or probably has derailed, the war of nerves that was launched by Saudi Arabia last year against America's fracking industry. Now, the oil kingdom's gambit, let me tell you, it did work, right, because it did adjust our production, and as a result, we've seen demand. Well, they had a chance to raise rates or cut their production, but they didn't. They started this war to hurt American frackers. As a consequence, prices collapsed. But also as a consequence, U.S. rig count collapsed. Our capital expenditures have been curtailed significantly. Think about this. The latest tally, we had 27 oil and gas rigs that were taken out of production. The total, 905, down from 1,931 just September of last year. Look at this thing, completely off a cliff. It's impacted U.S. crude production. So it's also now finally helping prices to rebound. Yet this lower production alone doesn't explain why crude oil has bounced 50% from the recent lows. What does make sense, though, is that the war that Saudi Arabia in their backyard is starting to hurt them. The situation in Yemen has not improved. The Houthi rebels continue to spread, even launching rockets into Saudi Arabia, killing 3 people this week. The writing is on the wall. It's going to take more than airstrikes if they're going to destroy these guys. And, of course, considering that Saudi Arabia's military expenditures, they probably knew. Take a look at this, guys, if you will. Saudi Arabia spent $80 billion, the number 3 spending in the world, of all countries in the world, over 10% of their budget, of their GDP, for only 30 million people. They had a feeling something like this was going to happen. They've been preparing for Armageddon for a long time. So as a consequence, they're going to probably have to let crude oil prices go higher. That means giving market share back to American producers, but it also means that oil prices go a lot higher from where they is right now. All right, guys, well, we had a pretty good day for oil. I think we tickled 62, or we got near 62. We closed up fractionally, but we're still at that 61 area. Listen, it's the highest of the year. We're up 50% from the low. Jim, I asked you earlier, but I know you're looking for a pullback, but can we get back to the lows of the year? Because I think what's happening in Saudi Arabia is setting the tone now.
Yeah, no, I don't think you're going back to the lows. What I think is happening, though, has to do with markets and short squeezes and hedge funds that made bets rather than an increase in demand for oil from $40 to here. So I think oil between $50 and $60 a barrel is probably the normal state for now. We've put in the bottom, and I think we're close to putting in the top.
Although we had a drawdown today on oil, and production is going down, there's another part to demand, right? It's supply and demand. So even if demand doesn't move that needle, if we start to suck supply out, that skews the price.
I think we found the bottom, I've been saying, but I think we're also close to the top. We're going to be in a trading range. We talk about the rig count, but there's also the wells, what they call backlog fracking. A lot of these wells are halfway done. About 3,000 of these wells are halfway done. And when oil starts going up like this, they could turn those on within 1 to 3 months. They can start drilling that. They're saying up to 3 million barrels a day if all these half-done wells get back on. So once it gets to 65, 70, these are coming back online. Supply goes up, price goes back down.
Yeah, one of the answers to low prices of oil is the low price of oil, because then you have to guys stop. The answer to the high price of oil, you know what? Price goes a little higher, turn those spigots back on, and you'll push it down. I think we're going to be a little trading.
You said high price of oil. There wasn't long ago we consider high price of oil with over 100 bucks.
Absolutely.
So 60.
I think we're in a new normal now, because the U.S. makes money at around $70 or so. So yes, a lot of the marginal players have been flushed out. Russia, I do think the U.S. ranked second in the war that Saudi took. Russia ranked 1, but I do think as the price of oil stays around this level, goes a little higher, I think you're going to see those shale producers come back.
Let's talk about Main Street for a moment, Scotty. You've been filling up. Have you noticed it already?
I think you absolutely noticed it. I think I just filled up my Suburban this past week, and I literally noticed there was about a $15 difference.
You got a Suburban?
I do. I have the biggest. I have it short of a tank. It's the best thing I can get to haul my family around.
But you're not cracking 100 yet, though.
No, but not yet. But we're getting really, really close. And I think this is where we're going to start to see. It's one thing when you say that people aren't saving it. Fine, okay, they didn't necessarily spend it at that point. We're going to notice it, though, as it goes up. And that's what I think you're going to see Main Street really start kicking in. And this is why the whole reason I've said from the very beginning why Saudi was trying to cement their friendship with the United States, our dependence on them to defend them from a military standpoint.
Well, I'm happy that they did their own airstrikes, but the problem, to your point, is who's going to put the boots on the ground and stop those Houthis, and I don't think Saudi Arabia wants to. They're a very comfortable country over there.
So January, February, March, we had this terrible weather, but our stock market did great. And it was really because that low price of gas, I really feel that it made everyone...
But we never saw it materialize. It didn't materialize in retail sales. It didn't materialize anywhere.
That drop in oil, that cost a lot of jobs. That low price hurt jobs.
Okay, but that's what we're paying for now. But I think that those 3 months, but it did reflect in the price of stocks. All those stocks went up in all those sectors except for energy. Now, energy is coming back, but I think that we have to be prepared.
I think this is true. I think Wall Street was we threw out the confetti way too early when crude oil started crashing. Everyone said there was going to be an immediate impact to the economy. It did not materialize, but consequently, I do believe higher oil will scare consumers. I just think it's going to work out.
The auto sales, Charles, the auto sales in Suburbans, these big gas guzzlers, went through the roof over the last 6 months. Why? Because people know they're filling it up less.
SUVs, trucks, that has
what has led us to That's backward looking.
And they're going to taper off now.
Yeah, as these prices go up at the pump, those sales will level off. You'll see a little bit more of a shift towards more of the fuel-efficient cars, especially if interest rates go up and your loan cost goes up and the maintenance on the car goes up. I think you've seen your best numbers.
I think those are hopeful consumers right there.
Well, I do believe it's going to probably have more of a negative impact on Main Street than it had as a positive impact, because that's the psychology we're in right now. Hey, guys.